It is November 16th. It's a Monday night. And this is the video log that takes 30,000 to a million. After I review the accounts, I'm going to talk about managing risk when selling options on Robinhood or other platforms. So first, let's go into the account. That is not the account. This is the account. I'm sitting at 131,132. I have not been adding money. So this is our natural gains. I've added like $1,000 in the last 8 months or something like that. This is the year chart. So I think my absolute low was like in the 40s back in March, and now I've recovered nicely all the way up to 131. I'm just a hair away from my all-time highs here at 132 on September 1st, I think. Perfect. Now I'm going to go through the positions. This is the symbol, the ticker, and then the strike price, whether it's a call or a put, the expiration date, number of contracts, and whether it's a sell or a buy. I'm going to quickly run through them. You can pause your video at any moment to find out the exact details of each position if you're interested in doing so. On the right, the number is just a daily valuation change in liability. So it was a fairly quiet day. Apple went up a little bit, so did the Apple call options. And then other notables are realty income and of course Schlumberger or Schlumberger. If you know how it's pronounced, let me know in the comments because I really want to know, so I stopped mispronouncing it. And Road That Shell, but I've already pre-sold Road That Shell at 30, so none of these gains are really actually mine. The options are running in the opposite direction of the stock at the moment. Here is the account tab. I'm going to quickly run through it. Sorted by total return and then sorted by equity. You can see my top 5 positions are positive, which is excellent. Very, very good. Now, let's talk about managing risk when selling option. Not managing risk, but what are the risks? You got to be aware of the risks. And there aren't many. That's why I do this strategy, right? That's why I'm doing this, because there aren't that many risks. If you sell an option and the trade doesn't go it doesn't go your way, you shouldn't really be worried, because you get to collect either your collateral back or you get to collect shares that you wanted in the first place, plus a little bit of premium. I mean, how is that a lose situation, right? It's not. However, what you do lose on is opportunity. So there's an opportunity cost to selling options. This kind of strategy really doesn't like volatile movements in the markets. It likes calm, even markets, like that graph of Cameco that I've been showing so many times. If you want to see it again, let's take a look at it again. Let's pick on Cameco, and there are some other graphs that are similar. If I pull out to 5-year, you can see the 5-year, the price has barely changed. It started off at around $12. Now it's at $9.55. And I made so many thousands of dollars. I don't know how many thousands, but a few $1,000s selling options of Cameco. And I even have some running right now. I have 6 options running right now. Some of them are gonna expire, some of them are gonna have a $10 put here, which is probably gonna execute on December 18th. It's great. Here's my collateral that I've put up, $1,000, 500 shares. Total return so far on this batch of options is $98. So liability still I have yet to erase is 122. So I've been making money on this for a long time. So that's kind of what you want when you're selling options. You want a graph that's fairly even over the very long period of time. But you obviously you got to do some more research than that. It's not that simple. You need to know that the company's not going to bankrupt. You need to know that it's probably bottom of a cycle if it's a cyclical stock. You need to know that it has solid profitability and cash flow if it's not. So there's a lot of things to consider outside of just whether the graph looks sideways or not. But it's a good start. Anyway, so actually let me just show you on Apple stock on the options menu what the risks are visually, because it's a little bit easier to understand. So first thing you want to do when you're selling options, of course, is pick the expiration date. So I'm going to pick December 4th. Currently, Apple is selling at and being bought at around 119.90. So if I want to sell a put, what I want to do personally is I'll pick a price target a little bit below the current price so I can get it at a discount if things don't go my way, right? Or go my way, depending on if I'm trying to acquire shares or keep my collateral. Collateral meaning the cash I put up and lock in a box for Robinhood to keep there in case I need to be called upon to buy the shares. So let's say I want to sell a put with a strike price at $118. I will be collecting $205 roughly of premium for putting this trade on, for writing this contract. And if the price stays around the same level here, let's say it's at exactly the same level on December 4th, this is really good news for me. I get to collect my premium of $205, and maybe I can sell another option, or I can write another contract for another month or something, or whatever duration I want, and collect some more premium. And that's fine. If the price of Apple drops to, let's say, 117 or 116, that's terrific, because my total all-in cost for purchasing 100 shares will be below that if I count the premium, which I should, and it'll be 115.95. So I'll still be winning. And even if it's a little bit below that, whatever, I lost a little bit. But where I really get in trouble is if the price is really volatile. If there's a huge shift in the market, if there's a tsunami in the market price. So let's take a look at what happens, yeah? Let's say on December 4th, Apple is at 128 instead of 118. Then I'll be sitting on my $205, fine, and I get my collateral back, fine, but I can't just re-roll it into another put option with $118 strike price. Especially not for the same money. I mean, the stock is going to be way more expensive. So I'm going to get almost nothing if I want to sell a 118 put option. Like, that's out of the question now. I have to either sell at a much higher price and not get nearly as good of a deal, or look for another opportunity. I'm done selling options with Apple. So I have to take my $205 and run. And now those are my gains, maybe for a year or two or forever. Right? But if I had bought the stock at 118 instead of selling a put, then I would enjoy $1,000 of gains from 118 all the way up to 128. I would enjoy that. It's much better than 205. And not only that, but I don't give up any potential other upside unless I sell. So I would have those shares with $118 cost basis, and they could keep running forever. So I kind of forego exponential gains in the hopes of getting, excuse me, let me turn off my heater real quick. In the hopes of getting $205, I forego all these future gains. So that's a problem if the stock goes up quite a bit, right? I have to look for something else. If, however, the stock goes down by quite a lot, it crashes, now I'm also in really big trouble. Because I collect my $205, but now I'm forced to buy an extremely overpriced stock. I'm forced to buy 100 shares of 118 when Apple could be at 98, let's say. So I'll be overpaying by a ton. Yeah, I'd be down on December 4th, I'd be down almost $2,000 if I do this. However, if I wait until December 4th to buy my shares, I've been buying them at a much bigger discount. You see how this works? So really what you're doing when you're selling options is you kind of selling the volatility of the stock a little bit. You're collecting some theta decay and you're hoping that the stock is not going to be too volatile so you can milk some more premium out of it. So the premium is directly related to how volatile something is. So if it goes up quite a bit and it goes up quite down on a regular basis, then what happens is usually you will have a very big number associated with that premium. It's going to cost quite a bit. I remember trying to buy a put for a Tilray one day when it had that super explosive spike up to 150. Maybe I should go on. This is implied volatility here, 29. When you're selling, by the way, you want to make sure the volatility is higher than implied volatility, because this is what the market thinks about it. It thinks it's a 29.06%. But if you think the volatility is higher, then it might be a good deal for you to buy instead of sell. If you think the volatility is less, then it might be a good idea to short that, meaning to sell contracts or write them. That's just Wall Street lingo. Okay, so let's go to Tilray, yeah, because that was kind of interesting. I remember these contracts back when it happened. So here's Tilray, currently 750, and everybody and their mother knew that this was a bubble at 148. And I tried shorting it. I really did. And I did for like maybe one day, but it was so expensive to buy a long dated put. I tried to buy a put for like, a few weeks or a few months. And over here it cost me, 148, what was it, like $10,000 or something like that. It was something absolutely ridiculous to buy a put until rate at 148. I didn't even have the money like in the account at the time, so it was fairly ridiculous. But everybody knew it was a bubble, so everybody wanted to short it, and the volatility on the stock was enormous, and so the premiums were sky high. So if you want to sell call premium, that was probably pretty good. And the disparity between the calls and the put premium was huge. So for the same price action on the downside, if I were paying $10,000 for a put, I'd be paying like $1,000 for upside call. So it'd be 10 times the price. So that means that all the options traders, everybody knew what's going on here. Everybody knew, Windows Defender summary did not find any threats. I know there's no threats. See fewer notifications. So okay. Can I just record this video? My goodness, Windows. What a bad time to do a virus alert. Anyway, no edits, okay? This is cool. We're just chilling. So what was I talking about? So yeah, the calls were so much cheaper than the puts because everybody knew it was going down. And now it's all the way down at 750. It's craziness. But so that's the cons. I mean, there's risk in selling options as well as buying options. You could lose money doing both. You could get locked up. But the main thing that I like to think about it is the loss of opportunity to participate in either collecting a really low price of an equity if I was patient. Like that's something that Warren Buffett might do, right? He might wait for the stock market to crash and settle until he starts purchasing companies. So that way he doesn't lose out on the opportunity of picking up dirt cheap companies. Whereas if he were to sell puts a little bit below the market, then he'll be forced to buy a company that's really expensive for his taste relative to where it's at market-wise currently. And same thing for the calls, right? He wouldn't want to miss out any of the upside, and so he doesn't perhaps sell call options either. However, I do know that he has sold put options before on the market because it was a very hot commodity back in the day when there were some rule changes and there was some requirements that were instituted for big financial players to have some kind of protections. So they were looking for people on the other side of those trades to sell long dated put options, and Warren Buffett was the guy, right? He's got a lot of money and he's a bull in the US markets. So that's what he did. He sold put options, long dated ones. And the funny thing about that trade is that they were not allowed to back out of it. They can't liquidate the trade until like 10 years later. And in the short run, the banks looked like really, intelligent move because 2008 happened and stocks crashed, and how those options weren't worth much at all. Um, and well, I mean, they were worth a lot. I mean, but not for Warren Buffett, right? It looks like he was losing the trade, but eventually market rebound and it cleared out its former highs. So Warren actually made out like a bandit on that trade. It's a pretty crazy story. Anyway, so outside of the regular, outside of instances like that, he doesn't really, not really that much of an option trader, right? Not like as much as I'm doing anyways. I have like 50 contracts running at the same time. So we're not playing the same game, that's for sure. Okay, now that I'm done comparing myself to Warren Buffett, I want to stop it right there. Hopefully, y'all are making even more money than I am. I've had a fairly good week, fairly good month, fairly good run, fairly good year, fairly good duration of the account. And I hope y'all have had even a better experience. Let me know how you're doing. And also, if you know how to pronounce Schlumberger or Schlumberger. Let me know how it's pronounced. Peace.